Hello, this is the Chart Profit video, an hour into the trading day on the 15th of September. This from the pre-open today. Just to recap here, we're looking at the E-mini S&P. Back on the 31st of August, I noted that the minor 3-month value area high was at 24.57, which is down here. And we said that price acceptance at that higher level would indicate that a distribution which would be higher or up has begun. You can see to the left of the graphic here we've had value being built above that level, and then on Monday of this week E-mini gaps higher, aggressive buying was marked here, and then subsequent to that we've had 3 value areas from Tuesday through Thursday being built above that level, above that point where aggressive buying was marked, with the market holding the breakout here to new highs. Down here at 24.64 we have a 3-month point of control. Look here on the 30-minute bar. Currently you can see the December contract here printing well above that level. That's the first level support, and we're ranging with the E-mini printing just above 24.90 currently. You can see here on the pulse chart the green bars at the top here indicating where we've marked aggressive buying on the E-mini. So the last 3 imbalances have all been green. The breadth in the middle here, the short-term breadth indicator, is back to green, and price momentum is up and positive. So this is a pretty healthy looking pulse chart. You can see up here the breakout, and we're holding above the August high currently. See here on the daily breadth indicators for New York through Thursday, these 2 bottom indicators above the levels which indicate a supportive position, as I put it. So these 2 indicators together giving this green bar here for the daily breadth indications. Interestingly, when we look at the sentiment here, the RIDEX ratio, you can see that as the market has come higher this week, the ratio itself has actually fallen, and that's usually in the short term not a particularly bearish indication. Remembering of course that at this point in mid-August we did see the ratio at an all-time high according to my database. And as I keep saying in the pre-open, the ratio hitting a new high is usually a warning for the market. See a little bit clearer here if I show you the bear fund assets in isolation. They've rallied somewhat here, and the bull fund assets have actually fallen back. Interesting data in the public poll here from AAII. As I've written here, the bulls percentage this week had a huge jump higher, up to 41.4%. That was a jump from 29.3% who declared themselves bullish last week or the previous week. That's quite a dramatic difference, and that is now the highest bulls percent since January, remembering of course that these are contrarian indications. The bears percent this week fell very sharply as well. It's at 22%, a sharp move, down from 35.7% the previous week. And that is the lowest since April 2016. So the net result of that, the bulls minus the bears at 19.4, which is over here, shows quite a spike in optimism. That's the highest since January as the market breaks out here. In the Investors Intelligence, the newsletters poll, unlike the public poll, the Investors Intelligence poll saw a decrease in optimism this week. The bulls percent was lower at 47.1. That's the lowest since November 2016. Bears percentage is up now at 20.2%. That's the highest since December. And if we look at the flow of funds, look at US fund flow data, reported equity funds, including ETF, there was a net outflow this week of 410 million. That's pretty small, almost neutral for that week. But over the last 13 weeks, only 2 weeks have shown a net inflow. And in fact, in the data excluding the ETF flows, the last 12 weeks have all registered a net outflow. And we see the 4-week flow at the bottom here in black is just climbed back above 0. Let's have a quick review of the daily charts here. Again, the spider, the 8-month support here at 244.30 for a long-term investor. If we're looking at price above that level, it's in a strong position. See the spider has opened lower today here. Just put that in perspective on the weekly bar. We're currently here on this higher weekly bar that saw the breakout above the previous high. Looking at the Russell 2000 ETF IWM, the big level, as we know, is the 16-month, the big support at 136. We saw a probe below that here early in August, and we popped back up above that level. So it's a test and a rejection of that 16-month, and we've now climbed back above the 5-month here at 141.30. So that's the very minor kind of first level support on this chart, lagging a little behind the breakout on the large cap spider. But as long as it holds that level, it's in a strong position. Looking here at the daily chart for the German DAX index, this level here at 12,450 is the 8-month, and currently we've had a rally from sort of late August, and we are now printing back above that level in a stronger position. And the big mover at the end of this week is the FTSE 100, UK FTSE 100 index. We noted recently this level here, 74.13, the 12-month, and throughout August it was difficult to see the FTSE actually moving and printing time above that level. I'll show you the chart of the British pound against the dollar in a second. We'll understand the main cause of this sharp fall at the end of this week. But the FTSE at the end of this week printing its lowest level since early May, late April. Okay, so here is that chart of the pound. This is what I call the Brexit high, and this the low in October. The pound dollar, the halfway point came in here on this dotted line. That was the natural resistance. That's where we saw the early August high. We saw a setback at that point down to the 5-month, which got built in here, and then when we popped back above that level and just consolidated for a few days, put that chart, as we mentioned in the pre-open, back in a strong position with this level as resistance. Now when this resistance here was overcome just in the last couple of days, the move in the pound has accelerated sharply higher, now printing its highest level since back over here June 2016, which was the week, that big bar there, of Brexit. We said across this whole period here, this consolidation period, as long as we were holding above 124.78, which was the big 15-month support, this was bullish. We found that resistance there, but now as long as we're holding above that halfway point, which I will remind you of day to day in the pre-open, the pound versus the dollar is in a strong position. A sharp move higher for the pound dollar, probably more to, well, certainly more to do with the British pound and potentially where interest rates are heading, rather than the dollar. Although the dollar is, this is the dollar index we're looking at here, the dollar is a little lower on this index chart. But we'll say it again, as long as the index remains below 93.41, which is the 3-month, it is in an extremely weak position. This is the Euro FX chart. It's been one way since April, and that's been higher. We overcame the major controlling price at this point here, that little higher low, and much higher, and holding these higher prices currently. As is the Aussie dollar. We said in the long-term time frame, this really major level here at spot 76, and I said the other week, looked like we've seen potentially a higher low here, which can be long-term bullish pattern. If we look at the dollar yen chart, this being the low, important low in 2016, in an interesting position regarding the levels. So from this low to this high, we have this natural halfway point here, natural support, and we saw on the 4th attempt, we saw the support broken at this point, which put the chart in a really weak position, especially as we were printing below 111.30, which is the 2-year controlling price. But as the dollar started to rally at that point against most currencies, we saw a bounce back, and what's happened now is we've just probed up into that 2-year controlling price, which is clearly the resistance on this chart. Price printing above 111.30 actually put the dollar in a strong position here, dollar yen in a stronger position, so time printed here, but we haven't seen that yet. We've just seen a very brief probe up into that level But when viewing the dollar, this remains going into next week a key chart and a key level. GLD, the gold ETF, inversely mirroring, if you like, the move in the dollar and the index, where we've seen strength just until the last 2 or 3 days, or the last week, where we've seen a little weakness as the dollar's rallied back. With the North Korea situation, gold has been attracting a lot of media and comment regarding its safe haven status. Has attracted a lot of attention and inflows, which may in a kind of contrarian way not be that helpful, but as long as GLD remains above 119.84 and that major point of control does not migrate, this is a strong position. So we have room to correct back here and remain long term in a strong location. Looking at USO, the oil ETF, the major migrated down from up here somewhere. At this point migrated down to 10.14. We've actually seen quite a strong rally back through the end part of August, and USO is now printing above that major level. Time above 10.14 would be a bullish positive indication. Technical indicators getting a little overbought here, and personally I'd like to see some kind of consolidation pattern or a higher low above that level before assuming higher, but that's a good start to make some progress above that level. T-bond ETF, TLT, last week reached its highest level since November, just a little way below the natural resistance here at the halfway point of this high. Unless this 8-month at 121.63 migrates higher with time spent sort of around here somewhere, which it may, I don't really have any local levels here to key from. So long term we're in a strong position above the 8-month and the major at 119. Clear resistance a little higher, just above 130. So stronger long term indication would be price printing time above 130. Okay, that concludes. Once again, I wish you a good weekend.